All right, today we're diving deep into Coal India Limited. This is a straight-up, data-driven look at the company's strategic position, breaking down the core bull and bear arguments that are really going to shape its future.
So at the heart of this whole story is a really fascinating paradox. I mean, how does a state-owned coal giant not just survive, but actually thrive when the whole world is pushing for a green transition? Well, Coal India's role in the country's energy security, it makes it a totally unique case.
Okay, to really get a grip on Coal India's strength today, you got to look back at what was basically a perfect storm in fiscal 23. You had the post-pandemic recovery kicking into high gear, plus the global energy crisis, and boom, demand for domestic coal just went through the roof. This let Coal India charge an absolutely staggering 329% premium in its e-auctions. I mean, that just flooded the company with cash and really set the stage for everything we're seeing now.
And that brings us right to the bull case. Let's break down what's really propping up the argument for Coal India's financial dominance and its incredible ability to generate cash. So first off, just look at the sheer scale we're talking about here. Coal India isn't just a market leader, it's the market. We're talking an 80% market share. And with a target of hitting 1 billion tons, well, that kind of scale creates a massive, massive barrier to entry. Who's going to compete with that? So if you're that big, how do you protect your profits? Well, it all comes down to efficiency. And this first-mile connectivity project, it's a total game changer. They're basically ripping out old, expensive road transport and putting in modern conveyor belts and silos. This isn't just some small adjustment. It's a huge operational shift that's expected to boost margins by 15 to 20%. Why? Because it's just going to slash their logistics costs.
Now, let's talk about pricing power, because this is huge. In their e-auctions, where the market sets the price, they consistently get about a 35% premium over their regular government-set prices. What does that tell you? It shows they're running a value-over-volume strategy, and that gives them this really powerful cushion against any rising costs.
And check this out. Sometimes it's a regulatory change that makes all the difference. Back in September 2025, a change in the GST fixed a huge, long-standing tax problem for them. This unlocked billions in trapped input tax credits. Just like that, one move, and their cash position swelled to over 45,000 crore rupees. That's a massive, permanent improvement to their finances.
So, what do you do when you have literally zero debt and a mountain of cash? You reward your shareholders, right? And that's exactly what they do. That huge cash pile is why they have one of the best dividend yields you'll find in the large cap space. We're talking around 5.8%. It's a textbook case of giving value straight back to investors.
But they're not just resting on their laurels, They're also looking ahead. They know coal won't last forever, so they're hedging. They're building out a 3-gigawatt solar pipeline, and they've even secured blocks for critical minerals, like rare earths. These are really smart moves that signal they're trying to pivot and become a much more diversified energy company for the long run.
Okay, but it's not all smooth sailing. You've got to look at the other side of the coin, and that brings us to the bear case. Really, it all boils down to one major challenge: cost headwinds. And we're talking big, structural ones.
And look, this isn't some theoretical risk we're talking about. It's already hitting their bottom line. Just look at Q3 of fiscal 26. They had to set aside over 2,200 crore rupees for pay provisions. That one thing, just one line item, was enough to make their quarterly profits drop 16% from the year before. It just goes to show how sensitive they are to wage inflation.
And the pressure we saw in that quarter, it's about to get a lot worse. There's a major worker wage revision coming up in July 2026, and the forecasts are for a massive 14 to 17% jump in employee costs. For a company where wages are already a huge part of their expenses, that's a really big deal. So this is what it all boils down to. This is the central conflict for Coal India. You could call it the value compounder's dilemma. How do you balance that incredible structural cash generation against these stubborn, rising legacy costs?
And this visual really lays it all out, doesn't it? The big green bars, that's the powerful cash flow machine we've been talking about. But that thin red line, that's the constant threat of rising operating expenses. So the whole game for Coal India, the key to their future, is whether they can keep those green bars growing faster than that red line.
Which brings us to the fundamental question that really defines everything for Coal India going forward. We've seen the bull case, right? They've got operational efficiency gains and serious pricing power in their corner. But then there's the bear case, those structural cost headwinds that are pretty much guaranteed to hit. So can the good stuff overcome the bad? Can that efficiency and pricing power really win out against rising costs?
That's the challenge, and that's the question we're left with.